Hey everyone, happy Monday. Welcome back to my channel. I'm CaitlinMcKeague. I am a real estate broker here in Phoenix, Arizona. I am here for my Monday market update, and today I am live. I am going to admit to you guys, it was not planned to be live today. I had a little bit of a glitch in my recording, and so here we are live instead. But that's awesome. I'm happy to be here with you guys. So drop me a comment. Let me know that you're here. And we're just going to jump right into everything. Before I do that, make sure you hit subscribe if this is your first time so you can be here for every Monday market update. And you guys come follow me on Instagram. I'd love to see you there at your Phoenix real estate agent. So let's just start with what's been going on. Let me take off all of this extra stuff. And we're going to talk about the CPI numbers because last week we had a pretty big week with this CPI data coming out lighter than expected. Actually came out at 7.7%. And it was about, I don't know, around 9% about 5 months ago or so. And this really affected the market because it came in lighter than anticipated. Economists had expected prices would rise at an annual 7.9%, and it reflected 7.7%. So they also expected a 0.5% month over month. And 5%, 0.5% month over month. But anyway, what ended up happening with all of this is we actually saw a very big reaction in the markets. We ended up seeing Dow pops 1,200 points, S&P 500 jumps 5% in biggest rally in 2 years after a light inflation report. So we hit some records in the stock market. Hi guys, thank you for joining. That's awesome. Glad you enjoyed the market updates. Hi Sean, thanks for your thoughts. I have some different info I'm sharing today, but hey, no one has a crystal ball, so who knows? Thanks guys for joining me. All right. So the Dow and S&P 500 markets exploded on this light inflation report. And you know what else was affected, of course, was mortgage interest rates. So I'm going to show you guys more information about that in a second. This is just another article, stock stage blowout rally after a milder CPI print. So all in all, it's some good news that we're starting to see a little bit of a let up in inflation when we look month over month. However, it's not a huge change, and we are still, the Fed is not really changing their trajectory at this point. They are certainly not pivoting. There's talk of maybe a pause eventually, and at what point will we get there to where a pause is likely? We don't really know. But let me talk to you real quickly about these mortgage rates. So 1 second, I gotta switch screens here. If you are buying right now and you're in the market, I hope you locked your interest rate last week, because this effect from the CPI report affected markets, and it also affected mortgage rates. Sorry, I'm trying to get this off here so you don't have this blue. But what happened, we went from 7.22% on average to 6.62% change in 1 day on mortgage rates. And so that is a pretty big change. So if you are a buyer out there, I hope you locked your rate. If not, check in on this stuff, because I don't know if we're going to get back down to the mid sixes anytime soon. And it'll be interesting to see if this change, this 1 day change, affected the number of homes that we see under contract and our activity. If people jumped back out there briefly, if we're going to have a spike in the data after seeing that change. So interesting to see the big change in rates, but not surprising when the markets rally like that. So let's get back to what we were talking about here. Moving over to In other economic news, as I'm sure you guys have been hearing, we also are seeing a lot of different layoffs today. Amazon announced that they're going to lay off 10,000 workers as soon as this week. It's actually 1% of their workforce. So that's a pretty big layoff. And we also have seen other companies, especially in tech, Meta, which is the parent company of Facebook, Twitter, also laying off thousands of employees this month. So overall, in the economy, this is not new. We're hearing a lot about layoffs, budgets being cut, and so obviously this is what will change our unemployment rate, and whether or not we're in a recession, if they want to officially call that, once we have an unemployment rate that spikes up. And then what happens when we're in a recession is usually rates come down. So we have that silver lining to look forward to, if you want to call it that. And so, if you are still employed and can still qualify, you may be able to have a better interest rate if we are in a recession in the future and rates come down. But anyway, I like to bring that up because obviously the overall market, or the overall economy and labor market and all of those things really play a role into how the real estate market is affected. So looking at this stuff is important as well. So let's jump into the Phoenix market. And as you guys know, I'm always looking at the Cromford report and all the awesome data that they get. But you know what? I was wrong. I was wrong last week when I made a guess, which I should have never done, that we would be officially in a buyer's market this week throughout Phoenix. And you know what? Oh, we are. Okay, so I was looking at this earlier, you guys, and it was 90.2 all day today, and it just refreshed to 89.9. So technically, I wasn't wrong. We just dipped into a buyer's market in Phoenix in the last hour. So yay for me. I guess I can change the headline of my video this week. But if you're new here, the Cromford report has this thing called a CMI, the Cromford Market Index, which is basically a mathematical equation that helps us understand supply and demand factors in the market. And when you know supply and demand, you can understand appreciation rates and kind of anticipate where prices are headed based on that. And so anything between 90 to 110 is considered balance. And we've been in this balanced range for a while, but definitely drifting towards a buyer's market. And now we are officially in a buyer's market at 89.9. You can see our supply is at 82.8. So that means that we're about 18% below normal for supply. In other words, the number of homes on the market, the inventory is below normal. And then demand is also below normal, and it's even lower than our supply. So supply and demand aren't matching up. We have more supply than demand, which is what technically puts us into this buyer's market. So demand sitting at about 25% below normal. So that's where we're at with the overall Phoenix market. Yeah, Marks, you were right on top of it. That changed quickly. I'm glad to see that I was right after all, but not by much. All day I thought I was wrong. So obviously this is the Phoenix area in general, but they can actually break things down to the major cities within Phoenix, which I know all of you guys love to look at this every week. And so these are the major cities. For smaller cities, they don't have enough data to create the CMI per city, but this is 17 major ones. And what we're looking at here is, on average, month over month, we've had a more significant change this week than we had last week when we're looking at it at these numbers from a month over month basis. So average monthly change in the CMI for all of these cities this week was about 10.9%, negative 10.9%. And last week it was about negative 10.5%. So just slightly more aggressive this week, but nothing too crazy. But we're still moving in that direction away from a seller's market and moving in favor of buyers in all of these cities altogether. Fountain Hills is really the strongest that we have, which is technically still in a seller's market. It's pretty much the only one remaining there, although Scottsdale is. It's just kind of barely a seller's market. But Fountain Hills remains that way. The others, we have about 13 cities that are in a buyer's market and only 2 that are in a balanced market right in here. And then Fountain Hills and Scottsdale being still in a seller's market. So if you are a buyer in Fountain Hills, you're going through something that might be a little bit weird because it feels like everything is coming down and softening, but sellers are still hanging strong in Fountain Hills. But if you're looking to buy in Buckeye or Queen Creek, you might find that you're able to get a huge discount on the price and also seller concessions and repairs and all of the things because that market is just quite a bit weaker there. So depending on what you're doing, buying or selling, and where you're located, things are different throughout the valley. So this is always helpful to see. Yeah, Paradise Valley's gone down a bunch the last few weeks. They're the largest change that we've seen. I think it was like 36% or something like that on average compared to like the 10% on average that we're seeing for the rest of the cities. So yep, Paradise Valley is making some pretty swift movements. So if you're a seller there, just know your chances of being in a strong market are dwindling, as that's been kind of the trend. And something to point out here, the Cromford report looks at all of these numbers from a seller's standpoint. So that's why these arrows are red. It indicates that the market is deteriorating for a seller. And when those arrows are green, it means we're moving more in a direction favorable for sellers. So there were a few green arrows in here about a month ago when we weren't seeing such high interest rates. And over the last few weeks, as rates have gotten into the 7s, we saw fewer and fewer green arrows until now. It's been a few weeks of no improvement for sellers. So that's where we're at with the CMI city by city. I wanted to, oh, you're welcome. Thank you for joining as you're traveling. I'm glad I can keep you up to date. So also want to talk a little bit about demand because obviously that's been a big driver in how our market has been changing, because demand is really, although we saw a huge increase in supply as the shift started in May, the biggest factor that's been changing is our demand kind of falling off a cliff. And one of the best ways to look at demand is looking at the number of listings under contract. So the Cromford report has this graph here, which they added 2007 to, and I know the colors are kind of hard to tell the difference, but the 2007 graph is this lowest line down here. And then we have 2022, which is the greenish line, and 2021, which is the blue line. So this is measuring number of listings under contract. Obviously, we're in between both of them, but we are trending closer to 2007. And the reason why 2007 is notable is because 2007 is the year that we've had the lowest number of listings under contract on record in the last 22 years. So we are approaching that same level now, and it'll be interesting to see if this continues to there or if it kind of levels off. You can see this little spike here. This is when rates started to go back down briefly. And so we had a spike in our demand. And then as rates went up and into the 7s, we've seen this just totally taper off. So it'll be interesting to see if this spikes back up after we had this huge drop in rates last week. But we're not going to be able to see anything on this for a couple weeks. So it may not be until December that we'll actually see the effect of that interest rate drop last week. But listings under contract is a good thing to look at because it helps us understand where the demand is. Also, keep in mind, we may be starting 2023 with listings under contract as low or lower than 2007 because we're already at this point. So if we're going to compare January to January, it's very likely we'll start that demand lower than we did in '07, which wouldn't be surprised if that makes headlines, but just so you can kind of see the full cycle where we've come from, it's not that startling. One of the biggest differences too that we have today is that we don't have as many listings on the market. So in 2007, we were approaching 50,000 listings on the market. And today we have about 20,000. We also don't have as many distressed listings or pre-foreclosures and foreclosures. So it's definitely a different landscape. Although the demand is as low, it's for different reasons. And we're certainly not in the same market as we were in 2007. So let's talk a little bit about active listings, because that's a good thing to keep our eye on too. So like I said, we're around that 20,000 listing range right now. And we've kind of been hanging out here a little bit, had a little bit of a jump up, but it's been pretty stable. And I would expect this to probably stay stable or go down because we don't tend to have a lot of new listings during the holidays. And as we look at, past years, the last couple of years, we have so many more listings than we did then, but we're just not seeing like a major increase in active listings. One of the reasons this might start to go up a little bit is because our demand is so low. So we're not seeing as many listings go under contract. Therefore, we're keeping those active listings on the market and adding some new ones as we would normally. Therefore, the total number of listings could increase. So that's totally possible. Let's see. Buyers should be making offers 15% under asking, specifically if it's been on the MLS for months. Find a realtor that'll make multiple offers for you. Yeah, I mean, you can definitely make offers under asking. 15%. Sure. I would just look at comps, and I would look at, the specific city, the supply and demand, how long it's been on the market, all of those things. I wouldn't just blanket 15% over everything, but you certainly can be making low offers and see who bites. Not every seller really has to sell. And a lot of sellers aren't willing to negotiate all that much if they don't have to sell. And we're finding a lot of that just because they are comfortable. They just would maybe like to sell, but they don't need to. We're not in that fire sale territory. So let's look at new listings as well. So we talked about actives. In November so far, we've had about 2,496 new listings. We're about halfway through the month. So if we're going to continue on that trend, we may end the month around 5,000 new listings or so. Last month, we were at 7,400-ish new listings, and the month before about 8,800. So our new listings coming to market is definitely going down. And that's really what's keeping everything stable. New listings are not coming on the market and demand is staying low. So we're just not seeing, one of those factors increasing or decreasing significantly. They're kind of staying together. So I took a stab at Open Door. They weren't in a negotiating mood, apparently. It's so true. I've mentioned this, I think last week, that I've had a few clients offer with Open Door and go in pretty aggressive, and they won't even counter. They say, if we're too far apart and if your client changes their mind, let us know. So it'll be interesting to see how long they hold out for. They obviously, I did my video on Friday about how many homes they have on the market and how many they've sold over the last few months and that kind of thing. And eventually, I think they need to offload them, but they are holding strong right now, that's for sure, and not being too negotiable. So, all right, guys. Well, that's all I had for today. I appreciate you guys being here. I'll take a couple questions before I jump off here. Oh, I lost myself. Okay. Don't know why iBuyer sales are considered distressed, as they weren't given overvalued purchase designation when paying high prices that drove up the comp. Seems like a double standard. Yeah, I can't tell you why. I think the market conditions were just different at the time. So appraisers were looking at things differently than they are now. And some of the iBuyers have really been slashing prices. Eventually, it takes a while, but they will end up actually selling under value sometimes. So it's a good question, though. I know where you're coming from. So we'll have to see, you guys. I'm most interested to know where demand is going to go after that interest rate drop last week. See if we get a bunch of new listings under contract this week or next week. But it's also a time where we're going into a really slow period, with Thanksgiving being next week and approaching the holidays. So we may not see as much of an uptick. What we do know is that the demand is probably more than likely just under the surface there, because when rates ticked down to about 5.5%, we saw a lot of new listings go under contract, and those buyers kind of came out of the woodwork because they were sitting on the sidelines. So there is a tipping point where we'll spark demand, and with rates going down as aggressively as they did in a one-day time period, that may reignite a lot of buyers to jump out there. So thank you for all the work you do. Thank you for watching. I appreciate that. I'm happy to do all this. It helps me stay on top of things too. So I love doing it, and I like hearing from you guys. So thank you for joining and going live with me today and adding all your questions and comments throughout. I appreciate all the participation. And if you guys have any questions outside of this, check the description below. I've got a link for my to set up a time to talk with me, or just my contact information. So feel free to reach out anytime. And also, I also have a link for getting an instant home value, searching the MLS, that kind of stuff. So it's all in the description. Make sure you check that out, and come follow me on Instagram at Your Phoenix Real Estate Agent. All right, guys, have a great evening, and I'll be back later this week with some more great Phoenix info for you. I'll see you soon.